Welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, we're going to revisit my credit card cashback investment strategy. I talked about it in an earlier video, and it's my approach to taking the cashback and other rewards that we get from credit cards primarily, but also to some extent from online shopping sites like Ebates, which I think they've renamed to Rakuten. Why, I don't know. Ebates was a much cooler name. In any event, we take that money and we invest it rather than just mindlessly spend it. Part of the idea for me doing this and talking about it on this channel is to sort of demonstrate the power of compounding, to demonstrate how even relatively small amounts of money, when saved and invested, can, well, turn into piles of cash. And the thing I like about using cashback rewards is that it doesn't really require a change in the way we live. It's not as if we're dramatically reducing our spending, although that might be a good idea as well. But, we're taking cashback rewards that I think before we started doing this, we just sort of mindlessly spent. We're setting it aside and we're investing it. So what I'm going to do in today's episode is give you an update on where things stand, revisit what our strategy is, how we do it. I'm going to actually show you the portfolio I've created for investing it, how it's done. And then we're going to talk a little bit about my strategy of investing in individual stocks. For those that know me, the majority of our investment portfolio is in low-cost index funds. It's what I believe is best for the vast majority of investors, which for me, by and large, means everyone but Warren Buffett. And it's how we invest 85% of our money. I do invest in some individual stocks and enjoy doing it. And it's actually, for me, it's worked out. Maybe this is a bad thing. I've actually clobbered the S&P 500 for a number of years running now, largely, if I'm being totally honest, because a big portion of our investments is in Apple stock. It's been in Apple since 2013, and it's just been killing it. So I guess it's better to be lucky than good. But I'm going to kind of walk through my thinking on investing in individual stocks. And to do that, we're going to compare two companies, Tesla and Bank of America. I don't think I could pick two more different companies from an investor's perspective. So that's a lot to do. So let's get right to it. And what you're seeing on the screen is my, I call it, as you can see, cashback portfolio. So just a little bit of background. We started investing our cashback about a year and a half ago. And initially I did it in a Vanguard index fund that was separate from all the others, but then it kind of got difficult to keep it separate from other investments. So earlier this year, I thought, I want to check out one of the new investing apps. So I opened up an account at Robinhood and at M1 Finance. I ended up moving it to M1 Finance, investing mainly in bank stocks for reasons I'll explain in a minute. Tried that out for several months. M1 Finance was perfectly fine, but I didn't like having separate accounts. So I ended up moving it back to Vanguard. And then this idea hit me. Why not use Morningstar's portfolio tracker to keep the cash back that we're investing separate from all our other investments? It's very easy to do. And by the way, if you're new to Morningstar, I've done a 5 video series on how to use it, how to research mutual funds. I'll link to that. You can check it out if Morningstar is new to you. So this is actually the performance of my portfolio that you're seeing on the screen. Let me back up for a second, though. This is the portfolio. You can see there's not much to it. It's just one stock, Bank of America. And then I have some cash. And the cash has actually grown. I just updated the cash value based on cashing in some of the cashback rewards from our credit cards that we use. So that built up the cash value to over $1,000, which at some point I'm going to invest perhaps into Bank of America, where the rest of it is, or maybe another stock. But that's sort of where our portfolio is. Now, the interesting thing about this portfolio is you can see the balance is just over $15,000. I looked back at the very first video I did about this strategy, and it was just a couple of months ago. And at that time, the value of the portfolio was $10,146.50. That was back in July. So in less than 6 months, it's grown by a third. Now, part of that is from additional cashback rewards that we've earned. But trust me, while we earn a fair amount every month from the spending, we didn't earn $5,000 in the last 6 months with cashback. It came from the performance of the investment. So let's take a look at that. And that's one of the nice things about Morningstar. It tracks your performance, and you can see that I moved from M1 Finance back to Vanguard and invested most of the cashback rewards in Bank of America in the middle of October. You can see that's where the line starts here. And it didn't start out too good for me because Bank of America, I invested in it and I think immediately it went down. But then in November, it had one day when it was up by 15%, frankly, as far as I'm concerned, for no good reason. And in December, today's the 1st, so this is the first day of December. You can see as I record this in the late morning, Eastern time, it's in just one day up almost 3%. Again, obviously not a normal day. The market just happens to be up a lot today. As my wife likes to remind me, we could lose it all tomorrow, so there's always that. But you can see here that since we've made the Bank of America purchases, and we're looking specifically down here at the personal return, we've gone up about 22.5%. Obviously, we're not going to go up 22.5% every 2 months, and as I say, it could go down tomorrow. But that has accounted for a lot of the portfolio's growth. And again, from just investing our cashback rewards, we're at over $15,000. We've been doing that for about a year and a half. Now, our strategy is fairly simple. I prefer cashback credit cards and just redeeming the cash, getting it in my bank account, transferring it to Vanguard, and I'm done. So we use a couple of cards for that. We use the Citi Double Cash card, which effectively pays 2% on everything. 1% when you make a purchase, 1% when you pay off the credit card bill. We use that. We use the Amazon Prime card. We have a Prime membership, so we get 5% back on Amazon purchases, as well as any purchases at Whole Foods. So we use that card a lot. I'm actually in the process of moving some of my banking to Bank of America. And when I do, I'll start using some of the Bank of America credit cards because depending on how much you have at Bank of America, they give you extra rewards. And I think we'll end up with a pretty standard reward rate at Bank of America that's over 2.5%. So that's really good. And then when we travel, we use the Chase Sapphire Reserve card because you earn 3x points on travel and eating out. Not that anyone's really eating out at the moment. But then when you redeem those rewards for travel through Chase, you get a 50% bonus. So it's effectively 4.5%. And you can also transfer those points to travel partners where the value goes up even higher. And what I do is when we make those travel plans, I see what the value would have been, how much we would have paid had we not had those rewards. And I transfer that amount to the cashback portfolio. As you might imagine, we haven't been doing a lot of that because we haven't been traveling much during the pandemic. So we've sort of been building up our Chase Ultimate Rewards. So in addition to the $15,000 you see here, we have well over $1,000 in sort of built up Chase Ultimate Reward points that once we use them will end up as part of this portfolio. So that's our general cashback strategy. I will leave a link in the description below where you can check out some of the credit cards that we use. As I mentioned, we also use Ebates. Frankly, I refuse to call it Rakuten. We continue to use Ebates, and I think that's a great site to use if you shop online. It gives you cash back as well, and I'll leave a link to Ebates in the description below. So that's sort of the strategy. This is our result. This is how we've done it performance-wise. Now the question becomes, well, why did I invest in Bank of America? Among, of course, many other options. And in this video, I kind of want to compare it to Tesla, which is a totally different kind of investment, and it'll sort of underscore my approach and my philosophy to investing in general. So my general approach to investing, particularly when it comes to picking individual stocks, is to focus on stocks that have a great company, a great brand, but that are, if not undervalued relative to their earnings and cash flows, at least not overvalued and crazy, right? Now, that's fine, but what exactly does that mean? Well, let's take a look at both Bank of America and Tesla. It'll sort of underscore my own philosophy in investing. What you see here on the screen is Bank of America. This is at the Morningstar website. And this gives us sort of a bird's eye view of this company's performance, its stock. A couple of things that I look for. The first is the PE ratio, which you can see right here. Now, Morningstar uses what they call a consensus forward PE. What does that mean? It means they're basing the earnings part of that equation on what folks believe will be the future earnings of, in this case, Bank of America over the next 12 months. What they could have used instead were the trailing 12 months earnings. So the earnings for the past 4 quarters. Morningstar uses a consensus forward. You can get both figures. For my purposes, this is fine unless I have some reason to believe the consensus of forward earnings is just crazy. That can certainly be the case in some circumstances, but with a bank as old as Bank of America and its history, it's probably doesn't much matter. But the key is that this is a relatively low PE, particularly when you consider today's average PE of, say, the S&P 500. We can get that at the Shiller site. Remember, Robert Shiller wrote his book, Rational Exuberance, back in the day. He has what is called the Shiller PE. What we're looking at here, though, is just the current S&P 500 PE ratio, and it stands, according to Shiller, at about 37. Now, depending on what site you use, like the Wall Street Journal, could have a slightly different number. But again, that's good enough for our purposes. When we compare that to Bank of America and its consensus forward PE, you can see that Bank of America is cheap relative to its earnings, at least as compared to the S&P 500 overall. And in fact, for those that have watched my Morningstar series, you know this investment style box here. You know exactly what that means. That colored dot in the top left means that Bank of America is, one, a large company, and it's a value company. And again, value simply means that relative to other companies, let's say in the S&P 500, for example, it is relatively inexpensive, again, relative to its earnings. The other thing I like to look at for banks is the price to book. In other words, how does the price of the stock compare to its book value per share? You can see here it's 0.99. It was actually a little bit lower than that when I purchased the stock, which meant it was actually selling for less than its book value. Now, in the case of a bank, that is not unheard of by any stretch, but of course not all banks are selling for less than book value. But those were both indicators to me, this is a value stock. Now, sometimes it's a value stock because it's a real stinker and no one wants to buy it. But in Bank of America's case, my view was, no, that's not the case. It's got an incredible brand, an incredible footprint in the banking industry. It's invested significant amounts of money in technology. Do I know what the future is going to hold? Well, no, of course not. That would be true of any investment. But I felt like it was a reasonable investment, a reasonable chance to grow the purchasing power of my money. That's why I invested in Bank of America. Now, one of the things that I also consider is, would I be able to stick to this investment if the day after I buy it, it drops by 50%? And in the case of Bank of America, I thought the answer would be yes. Certainly, there's been a lot of volatility in the market this year, and who knows, maybe it could drop by quite a lot in a short period of time. But I think that its financials are sound, particularly after all of the improvements to the safety and soundness of banks following the 2008 crisis. And so I felt very comfortable. Now, you'll notice it does have a dividend yield of roughly 2.5. A lot of people will focus on that. I tend to think more that it's not so much that I love dividends, it's that I love companies that pay the dividends. And that may seem silly or like not much of a difference, but it actually really is. Dividends don't make you richer. They don't make you, it seems like they do, right? Because you get this money back and you haven't had to sell any shares. But if you really understand how dividends work, you'll know they don't make you any wealthier at all. And I'll stop there on that. I'll do a whole nother video or series on dividends. But for those that love dividends, Bank of America pays about 2.5% dividend yield. Now, how does all of that compare to Tesla? Well, let's check it out. Here's Tesla's page on Morningstar. And the first thing we notice is consensus forward PE is 140. So that means that assuming the consensus is correct, that what people think Tesla will earn over the next year, they in fact earn, their PE based on today's price is 140. So in other words, it will take you, again, based on consensus earnings, 140 years at today's price to earn back what you pay for the stock. Now, for me, that's kind of rich. And it's not the kind of stock that I would even consider. Now, this is based on consensus forward PE. With a stock like Tesla, I would not be satisfied with the consensus forward PE because it doesn't have the history that, say, a Bank of America does. Its earnings can fluctuate wildly. And I would want to look at its current PE based on trailing 12 months. And if we do that with Tesla, you can see here it's 1,150. So based on trailing 12 months earnings, it would take you over 1,000 years to earn back your investment. Now, by the way, if you think I'm being unfair because I show you this number for Tesla, but not for Bank of America, well, here's Bank of America, 14.3, not much different than the consensus forward PE. So Tesla is not the kind of stock I would even consider. And many of you listening may say, well, Rob, that's, because you're an idiot. And well, okay, apart from that not being a very nice thing to say, I get it. Folks would say, look at Tesla's stock. Look at its performance. I mean, just today it's up 2.5%, but if we go to year to date, it's up, it's gone sky high. In fact, we can go to another screen. Year to date, it's up 575%. And so here's the thing about what would be called a growth stock like Tesla. It's one that's not undervalued by any stretch, but it's growing its earnings, it's growing its profit, right? And it can have years like this. Bank of America, the odds of Bank of America ever being up 575% in 1 year, not very good. But here's the deal with Tesla. Its current price simply isn't supported by its earnings. That doesn't mean it's a bad company. In fact, if I were to buy a car today, frankly, I'd probably buy a Tesla. I think it's a phenomenal product. But given its price to earnings and price to book, its current trading price simply has become disconnected from the fundamentals of the company. Now, there are a number of reasons for that. It's in a new and exciting field. Electric cars are the future. Batteries are the future. And of course, as you probably know, it was recently announced that Tesla stock would be added to the S&P 500 in December. So that caused the stock price to shoot up. But eventually, this stock will come back down to earth. Now, you might say, well, okay, Mr. Smart Guy, when will that happen? I have no idea. That's the point. I have no idea. It could continue to have a PE of 1,150 for years to come. But the day will come when its stock price starts to reflect reality. Now, between now and then, there will be people that make a fortune buying and selling Tesla stock, perhaps trading in options, just like people make a fortune with Bitcoin, just like people can make a fortune with commodities, just like some people make a fortune with the lottery. But I don't have confidence that I can buy this stock and hold it for a long period of time, which is always my goal, and have a reasonable chance of making money. Because again, at some point in the future, the stock price is going to come back down to earth. My preferred holding period for a stock is forever. My hope is I actually never sell the Bank of America stock that I purchased. Now, again, this isn't the only approach to investing. Some folks would completely disagree with me and say, no, you should be in growth stocks. You should be in Tesla. You should be in Amazon, Google. And it's just generally not my approach. I don't think it's a sound long-term approach. Now, it's been a great approach over the last few years because growth stocks have done extremely well. I think the important question to ask is, why have they done so well? In my view, it's largely because the Treasury has been printing money. Money is cheap. It's effectively free when you want to go borrow it. I mean, the federal government is effectively borrowing money for nothing, and then depending on what the bonds they're issuing on a after inflation basis, you're actually paying the government. I mean, it's just gotten ridiculous. That will eventually change. I have no idea when, but it will. And when it does, I think there's going to be a reversal. Growth stocks will start to underperform value stocks. I don't get into trying to time the market. After 30 years of investing, I'm convinced that I can't do it well, and frankly, no one can. Notwithstanding the various courses people want you to buy on YouTube, you just can't do it. So I'm looking for great companies at a reasonable price that I can buy and hold forever. As good a company, really as great a company as I think Tesla is and its products, its stock simply doesn't meet that criteria. For me, a stock like Bank of America does. Now, I mentioned Apple. I've been a long-time investor in Apple. It's now probably considered a blend stock. And in fact, let's look it up in Morningstar and see what they say. Yep, so it's a blend. It's in the middle here. It's got a consensus forward PE of 30, which frankly is still pretty rich. And it's rich for Apple based on historical standards. But here's the thing. When I invested in Apple in 2013 and again in 2018 and 2019, it was a value stock, but its prices shot up so much that it's now a blend, or if not, maybe even leaning towards a growth stock. But it's a great company. I have no interest in selling any of my shares other than occasionally for rebalancing or tax purposes. But other than that, again, like Bank of America, I hope to hold my Apple stock forever. I also hope to hold my Berkshire Hathaway stock for forever. So that's my general approach to investing when it comes to individual stocks. In future videos, we can dive into all the details, including how to analyze financial statements. I think that'll be great fun. But this sort of gives you an overview. And then back to my cashback strategy, that's what I've done here. I've invested in Bank of America stock. Again, looking at just 2 months of performance, which is what we have, it looks great, but you can't put much weight on that. Let's see how I'm doing 10 years from now. That might be a little better indicator. If you have any questions about my cashback strategy, my investing strategy, please leave a comment below the video. I'll be happy to help you out any way I can. Hope you have a great day, and until next time, remember, the best thing money can buy is financial freedom.